What if I told you that becoming a millionaire isn't just about luck, but about the mindset, strategies, and habits you adopt? In this audiobook, you'll discover the proven principles that have helped ordinary people build extraordinary wealth. Ready to unlock your path to financial freedom? Let's dive in. Becoming a millionaire may seem like a distant dream, but with the right approach, it's more achievable than you might think. In this audiobook, we will explore what it truly takes to amass wealth, not through shortcuts or gimmicks, but through tried and true methods that work for anyone willing to put in the effort. Whether you're just starting your financial journey or looking to accelerate your success, this guide will provide you with the mindset shifts, strategies, and practical tips to take control of your financial future. We'll look at everything from mastering financial discipline and making savvy investments to building multiple income streams and leveraging the power of entrepreneurship. You'll learn not just how to earn money, but how to make it work for you over time. Get ready to transform your financial life. Focus points. Mindset for wealth. How cultivating a long-term growth-oriented mindset is the foundation for financial success. Financial discipline. The importance of budgeting, saving, and avoiding high-interest debt to grow your wealth sustainably. The power of investing. How to invest early and consistently, leveraging compound interest, and diversifying your portfolio to minimize risk. Entrepreneurship and side hustles. Why starting a business or scaling a side hustle can lead to exponential wealth growth. Networking and relationships. The impact of surrounding yourself with like-minded successful individuals who can help elevate your financial journey. Resilience and risk-taking. How learning from failure and taking calculated risks are key to long-term wealth creation. Continuous learning and adaptation. Why staying informed and continuously learning is crucial to navigating changing financial landscapes. Learning outcomes. Understand the millionaire mindset and how it plays a pivotal role in achieving long-term wealth. Master financial discipline by learning effective saving, budgeting, and debt management techniques. Develop a clear investment strategy that leverages compound interest, diversification, and early entry into markets. Identify entrepreneurial opportunities and side hustles that can generate additional income streams. Enhance your network by learning how to build relationships that support your financial growth. Learn to manage risks and recover from failures to keep pushing forward on your path to success. Continuously improve and adapt, keeping yourself informed on the latest trends and opportunities in the financial world. By the end of this audiobook, you'll be equipped with the mindset and tools necessary to take action, build wealth, and move closer to financial independence. Let's start your millionaire journey. Focus point 1. Mindset for wealth. The journey to financial success begins with the right mindset. A long-term growth-oriented mindset is essential for anyone seeking to become a millionaire. It's about embracing a mentality that prioritizes learning, adaptation, and persistence over quick wins or short-term gains. To cultivate this mindset, you must understand that wealth is built incrementally, requiring both patience and resilience in the face of setbacks. A core aspect of the millionaire mindset is the ability to delay gratification. Millionaires often make sacrifices today, whether in the form of reduced spending, investing in their education, or working long hours on their business ventures, to enjoy financial freedom in the future. This approach contrasts with the common desire for instant results, which can lead to impulsive financial decisions that hinder long-term wealth accumulation. Another critical trait is adopting a growth mindset, a concept popularized by psychologist Carol Dweck. A growth mindset enables you to see challenges as opportunities for learning rather than as threats. Millionaires view setbacks or failures as temporary obstacles and a chance to refine their strategies. This adaptive attitude allows them to overcome adversity, recalibrate their approach, and continuously move forward toward their financial goals. Millionaires also set clear, actionable goals that guide their decision-making. They don't just dream of wealth, they plan for it by breaking down their long-term vision into manageable steps. For instance, someone might set a goal to save $10,000 within a year by automating their savings and cutting non-essential expenses. Over time, these smaller goals contribute to a larger financial strategy that leads to wealth accumulation. One example is Warren Buffett, one of the wealthiest individuals in the world, who attributes much of his success to a long-term mindset. Buffett didn't amass his fortune through speculative trading or chasing quick returns. Instead, he invested in stable companies and held onto them for decades, allowing his wealth to grow steadily over time. His famous quote, "The stock market is a device for transferring money from the impatient to the patient," emphasizes the importance of patience in wealth building. Recommendations. Start by shifting your focus from short-term satisfaction to long-term growth. Recognize that small, consistent actions lead to significant financial results over time. Embrace a growth mindset. When you encounter challenges or setbacks, ask yourself, what can I learn from this? And use that knowledge to improve your approach. Set clear, specific financial goals and break them down into smaller, actionable steps. Track your progress regularly and adjust your plan as needed. Focus point 2. Financial discipline. Financial discipline is the cornerstone of sustainable wealth building. It encompasses the careful management of money through budgeting, consistent saving, and avoiding high-interest debt. Without this foundation, even those with substantial incomes can find themselves struggling financially. Financial discipline ensures that you're making your money work for you, rather than the other way around. Budgeting is the first step in taking control of your finances. It's about creating a clear plan for where your money goes every month, ensuring that your spending aligns with your goals. A well-structured budget helps you prioritize essential expenses while cutting down on unnecessary costs. This habit not only prevents overspending, but also highlights opportunities to save or invest. For example, allocating a portion of your income automatically towards savings or investments ensures you consistently contribute to your financial future without relying on willpower. Saving is the second key pillar. To build wealth sustainably, you must live below your means and save a significant portion of your income. While experts often recommend saving at least 20%, millionaires typically save much more than that. Savings act as a buffer during tough times and provide the capital necessary to seize investment opportunities. The earlier you start saving, the greater the benefit of compound interest, which allows your money to grow exponentially over time. Avoiding high-interest debt is equally crucial. Debt in itself isn't always bad. Mortgages or business loans can be smart financial tools, but consumer debt, especially high-interest credit card debt, can trap you in a cycle of repayments and interest accrual. This kind of debt can quickly erode your wealth because the money you spend on interest payments could instead be invested or saved. When you're paying 15 to 20% in credit card interest, it becomes nearly impossible to accumulate wealth over the long term. One instructive example comes from personal finance expert Dave Ramsey, who advocates for the snowball method of paying off debt. He suggests starting with the smallest debts first to gain momentum and build discipline, then moving on to larger debts. Ramsey's approach has helped thousands of people eliminate debt and start saving aggressively, laying the foundation for financial freedom. His approach demonstrates the power of financial discipline when it comes to handling debt effectively. A quote that reinforces the importance of financial discipline comes from Benjamin Franklin, who said, "Beware of little expenses. A small leak will sink a great ship." This highlights how small, undisciplined spending habits can undermine even the best financial strategies. Whether it's daily coffee runs or impulse purchases, small expenses add up and detract from your ability to save and invest. Recommendations. Create a detailed monthly budget and stick to it. Use budgeting tools or apps to track your income, expenses, and savings goals. Automate your savings and investments. Set up automatic transfers so that a portion of your income is always allocated to your savings or investment accounts. Prioritize paying off high-interest debt. Focus on eliminating consumer debt as quickly as possible to free up cash flow for saving and investing. Live below your means. Avoid lifestyle inflation, where increased earnings lead to increased spending, and instead funnel extra income toward your financial goals. Focus point 3. The power of investing. Investing is one of the most effective ways to build wealth over time, leveraging the power of compound interest and smart diversification to minimize risk. The earlier and more consistently you invest, the more you benefit from the exponential growth that compound interest provides. Rather than relying solely on savings, which can be eroded by inflation, investing allows your money to grow at a faster rate, accelerating your path to financial independence. The concept of compound interest is central to wealth building. It's the process where your earnings from investments, whether dividends, interest, or capital gains, are reinvested, enabling you to earn more over time. This creates a snowball effect where your returns generate their own returns. The earlier you start, the more powerful this effect becomes, as time amplifies the growth. Consider a person who invests $10,000 at age 25 with an average annual return of 7%. By age 65, that initial investment will have grown to nearly $150,000. However, if they waited until 35 to start investing, the total would only reach about $75,000. The key takeaway is that time is one of the most important factors in successful investing. Consistent investing, regardless of market conditions, helps you avoid the pitfalls of market timing, trying to predict the best times to buy and sell. History shows that markets tend to recover from downturns and continue growing over the long term. For example, during the financial crisis of 2008, many investors panicked and sold their holdings at a loss. However, those who remained invested saw their portfolios rebound and grow significantly over the next decade. This highlights the importance of consistency in investing, even in volatile markets. Diversification is another critical aspect of successful investing. By spreading your investments across different asset classes, such as stocks, bonds, and real estate and sectors, you reduce your overall risk. The idea is that when one asset underperforms, another might do well, balancing out your returns. Diversification can protect you from significant losses in any one area and ensure more stable long-term growth. For instance, during the dot-com bubble of the late 1990s, many investors who concentrated their portfolios in technology stocks lost a significant portion of their wealth when the bubble burst. In contrast, those with diversified portfolios were able to weather the storm more effectively, as other sectors, like consumer goods and healthcare, remained relatively stable. One well-known example is Ray Dalio, the founder of Bridgewater Associates and a leading voice on diversification. Dalio created the all-weather portfolio, designed to perform well in any economic condition by balancing investments across different asset classes. His approach illustrates how diversification can help mitigate risk while still allowing for substantial growth. Benjamin Graham, widely regarded as the father of value investing, once said, "The individual investor should act consistently as an investor and not as a speculator." This quote reinforces the importance of long-term, consistent investing rather than trying to time the market or chase short-term gains. Recommendations: start investing as early as possible to maximize the benefits of compound interest. The more time your money has to grow, the greater your returns will be. Set up automatic, recurring contributions to your investment accounts. This ensures that you are consistently investing, regardless of market conditions. Diversify your portfolio across asset classes and industries. A well-balanced portfolio helps protect against significant losses and increases the likelihood of stable returns over time. Focus on long-term growth rather than short-term gains. Avoid the temptation to make reactive decisions based on market volatility, and stick to your investment strategy. Focus point 4: Entrepreneurship and Side Hustles. Entrepreneurship and side hustles are powerful avenues for building wealth because they offer the potential for exponential growth. Unlike traditional employment, where income is typically capped by salary structures or hourly wages, owning a business or scaling a side hustle provides opportunities for significant financial upside. Through innovation, strategic decision-making, and scaling efforts, entrepreneurs can create wealth beyond what is possible with a single income source. Starting a business allows you to take control of your income and build an asset that can grow over time. A key advantage is that businesses are scalable. As your company grows, so does your potential for profit. Many entrepreneurs start small but, through reinvestment, strategy, and perseverance, are able to turn modest ventures into highly profitable enterprises. The freedom to experiment with different revenue streams and the potential to reach larger markets are huge benefits of entrepreneurship. Side hustles offer a more accessible path to entrepreneurship. They allow individuals to test business ideas or monetize skills without quitting their full-time jobs. Whether it's freelancing, consulting, selling products online, or investing in real estate, side hustles can generate additional income streams that may one day replace your primary income. Moreover, a successful side hustle can be scaled into a full-time business. For instance, what starts as a small online store could grow into a profitable e-commerce brand through online marketing, product expansion, and customer retention efforts. A classic example of entrepreneurship leading to exponential wealth growth is Jeff Bezos. What started as a small online bookstore in his garage became one of the world's largest companies, Amazon. Bezos scaled Amazon by continuously reinvesting profits into growth areas like cloud computing and logistics, demonstrating the potential of entrepreneurship to build generational wealth. Another example is the rise of Airbnb, which began as a side hustle when its founders rented out their apartment to make extra cash during a local conference. Today, Airbnb is a global hospitality giant. This story underscores how side hustles, even those that start with small, simple ideas, can lead to massive opportunities if scaled properly. As Warren Buffett wisely said, "If you don't find a way to make money while you sleep, you will work until you die." This quote emphasizes the importance of creating multiple income streams, such as those from entrepreneurship and side hustles, which can eventually generate passive income. Unlike salaried jobs, where you're trading time for money, businesses can create income that grows even when you're not actively working. Recommendations: consider starting a side hustle that leverages your skills, interests, or knowledge. Begin small but focus on learning and scaling your efforts over time. If you already have a side hustle, explore ways to automate, expand, or outsource parts of the business to scale it into a more substantial source of income. Reinvest profits from your business or side hustle back into its growth. This could be in the form of marketing, hiring staff, or developing new products or services. Network with other entrepreneurs and seek mentorship to learn from their experiences and avoid common pitfalls. Building connections within your industry can open up opportunities for growth and collaboration. Focus point 5: networking and relationships. Building wealth is not just about individual effort, it's also about who you know and how you leverage those relationships. Networking and surrounding yourself with successful, like-minded individuals can dramatically influence your financial journey. The connections you make can provide invaluable opportunities, advice, and resources that elevate your career or business to new heights. One of the most important reasons to build strong relationships is access to knowledge. Successful people often have insights that come from years of experience. By connecting with them, you can gain practical advice, avoid costly mistakes, and fast-track your progress. Networking creates a flow of ideas, information, and strategies that might not be readily available through conventional education. For example, attending conferences, mastermind groups, or business seminars allows you to interact with industry leaders who can share game-changing perspectives on wealth-building strategies. Moreover, your network can open doors to opportunities that you might not have discovered on your own. Many lucrative business deals, investments, or partnerships come through word-of-mouth referrals or personal introductions. A key benefit of being connected to a network of successful people is that they often know about high-potential opportunities before they become widely known. This access is particularly crucial in industries like real estate, technology, or venture capital, where insider knowledge can make the difference between a good investment and a life-changing one. For instance, Richard Branson, the founder of the Virgin Group, credits much of his success to his ability to network and form strategic partnerships. Branson often says that his businesses flourished because of the talented individuals he surrounded himself with. His ability to build relationships led to opportunities that would not have been possible through his own efforts alone. A powerful historical example comes from the Rothschild banking dynasty, whose wealth grew not only from their financial acumen but also from the global network of family connections they maintained. The Rothschilds were known for using their expansive network to share financial information across countries and capitalize on market shifts faster than their competitors. As the motivational speaker Jim Rohn famously stated, "You are the average of the 5 people you spend the most time with." This quote emphasizes the profound influence of your inner circle on your mindset, decisions, and ultimately, your financial success. By surrounding yourself with individuals who challenge you, inspire you, and push you toward growth, you cultivate a success-oriented environment that fuels your own ambitions. Recommendations: actively seek out networking events, business conferences, or online forums where like-minded individuals gather. Build relationships with people who are ahead of you in your financial journey. Develop a mindset of giving within your network. Offer value, support, and collaboration before expecting anything in return. Generosity often leads to deeper, more rewarding relationships. Nurture your relationships by staying in touch, following up regularly, and offering help where you can. Long-term relationships provide the greatest benefits, as trust and collaboration grow over time. Find a mentor who has achieved the financial success you aspire to. Their guidance can provide critical direction and insights that you might not discover on your own. Focus point 6: resilience and risk-taking. Resilience and risk-taking are fundamental drivers of long-term wealth creation. Building significant wealth requires the ability to navigate through failures and setbacks while being willing to take calculated risks that others may avoid. Those who succeed financially often demonstrate an exceptional capacity to recover from losses and learn from their mistakes, transforming challenges into opportunities for growth. Resilience is the mental and emotional strength needed to endure difficulties and continue pushing forward despite obstacles. Successful entrepreneurs and investors rarely experience a smooth journey. They face market crashes, business failures, personal challenges, and missed opportunities. What sets them apart is their ability to bounce back, recalibrate, and approach the next venture with renewed energy. This trait is evident in the stories of many self-made millionaires. For example, Walt Disney faced multiple business failures and bankruptcies early in his career before building the iconic Disney empire. His resilience enabled him to persist despite overwhelming odds, and his success came from learning from these setbacks rather than being deterred by them. Taking calculated risks is the other side of the coin. Long-term wealth creation often involves stepping into the unknown, whether through starting a new business, investing in a volatile stock, or pursuing an innovative idea. These risks, however, should not be reckless. They are calculated, meaning the individual understands both the potential rewards and the risks, and prepares adequately to mitigate potential losses. For instance, Jeff Bezos took a significant risk by quitting his stable Wall Street job to start Amazon in 1994. However, his decision was based on research, long-term vision, and an understanding of the growing potential of e-commerce, which ultimately paid off. Psychological research, such as the work done by Carol Dweck on growth mindset, reveals that individuals who see failure as a learning opportunity are more likely to take risks and succeed in the long run. Those with a fixed mindset avoid challenges and risks because they fear failure will define them, while those with a growth mindset embrace failure as part of the learning process. This difference explains why resilient risk-takers tend to build wealth. Each failure teaches them something valuable for the next venture. Thomas Edison encapsulated this mentality perfectly with his famous quote, "I have not failed. I've just found 10,000 ways that won't work." Edison's resilience and willingness to take risks were key to his success as one of the most prolific inventors in history. His legacy shows that wealth and success often come from a combination of risk-taking and learning from inevitable setbacks along the way. Recommendations: develop the ability to reframe failures as learning experiences. Take time to reflect on what went wrong and how you can adjust your strategy moving forward. Before taking any financial risks, ensure you've done your due diligence. Understand the potential rewards, the worst-case scenario, and how to mitigate losses if things go wrong. Build a financial safety net that allows you to take calculated risks without jeopardizing your entire financial future. Having savings or emergency funds in place provides the security needed to take bold steps. Foster a growth mindset by actively seeking challenges that push you outside your comfort zone. Taking risks becomes easier when you view them as opportunities for growth rather than threats to your security. Focus point 7. Continuous learning and adaptation. In today's dynamic and rapidly evolving financial world, continuous learning and adaptation are vital to sustaining long-term financial success. As global economies shift, new technologies emerge, and market trends change, staying informed and adapting your strategies becomes essential for navigating these complexities. Those who commit to lifelong learning are better equipped to seize opportunities and minimize risks in the ever-changing financial landscape. Continuous learning enables individuals to stay ahead of the curve, whether it involves new investment strategies, evolving tax regulations, or emerging industries like blockchain and green technologies. For example, investors who stayed informed about technological advancements in the early 2000s were able to capitalize on the dot-com boom and later the rise of social media giants like Facebook and Google. Similarly, those who learned about cryptocurrencies early on reaped significant financial rewards by recognizing their potential before they became mainstream. This type of learning requires curiosity, foresight, and a willingness to explore new ideas. Adaptation goes hand in hand with learning. As financial markets are often unpredictable, adaptability allows individuals to pivot when circumstances change. For instance, during the 2008 financial crisis, many investors suffered substantial losses. However, those who adapted quickly to the shifting economic environment, by diversifying their portfolios or moving into less volatile assets like gold or bonds, were able to mitigate their losses. Charles Darwin's timeless insight, "It is not the strongest of the species that survive, nor the most intelligent, but the one most responsive to change," captures the essence of why adaptability is crucial in the financial world. The necessity of continuous learning is further supported by studies in behavioral finance, which reveal that individuals who regularly update their financial knowledge make better decisions. Research from Nobel laureate Richard Thaler, a pioneer in behavioral economics, shows that those who are aware of cognitive biases such as overconfidence or herd mentality can actively counteract these tendencies and make more rational investment choices. Continuous learning helps in recognizing these pitfalls and adapting strategies accordingly. A real-world example is Warren Buffett, often hailed as one of the greatest investors of all time. Despite being in the business for decades, Buffett spends around 80% of his day reading and learning about new developments in the market. His ability to continuously learn and adapt his investment strategies has allowed him to remain at the top of his field for so long. Buffett's famous advice, "The more you learn, the more you earn," reflects how integral lifelong learning is to wealth creation. Recommendations: dedicate time each day to reading or learning about new financial trends, whether through books, financial news, or educational platforms. This helps in keeping up with industry shifts and staying informed about new opportunities. Attend seminars, workshops, or online courses on personal finance, investing, or emerging technologies. Continuous education enhances your ability to adapt to market changes and shifts in financial landscapes. Embrace flexibility in your financial plans. Be prepared to adjust your investment strategies or financial goals when necessary, based on new information or unexpected changes in the economy. Surround yourself with mentors or financial advisors who prioritize learning and stay updated with market trends. Their knowledge and experience can guide you in adapting effectively to changes. Conclusion: to become a millionaire, it's not just about earning more money, it's about adopting the right mindset, developing effective habits, and making strategic financial decisions. This audiobook has explored essential steps toward building sustainable wealth, offering practical insights and proven strategies. Key focus points: financial discipline, budgeting, saving, and avoiding high-interest debt are foundational to growing wealth responsibly. The power of investing, consistently investing and leveraging compound interest, while diversifying, helps build wealth over time. Entrepreneurship and side hustles, creating or scaling a business can lead to exponential financial growth. Networking and relationships, surrounding yourself with like-minded successful individuals can elevate your financial journey. Resilience and risk-taking, learning from failure and taking calculated risks are crucial to long-term wealth creation. Continuous learning and adaptation, staying informed and adaptable in the ever-changing financial landscape is key to success. Practical recommendations: track your spending and save first, establish a budget and stick to it. Prioritize savings and avoid debt that drains resources over time. Invest consistently and start early. Even small, regular investments compound over time. Diversify your portfolio to minimize risk and maximize growth. Pursue entrepreneurial ventures. Start a side hustle or small business. Entrepreneurship provides opportunities for significant financial growth. Build meaningful connections. Engage with individuals who share your vision for success. Learning from others' experiences accelerates your financial journey. Embrace failure and take strategic risks. Use setbacks as learning experiences and be willing to step outside your comfort zone in pursuit of greater rewards. Keep learning, regularly seek out new financial knowledge, and stay flexible to adapt your strategies as the market evolves. Throughout this audiobook, we've explored the key building blocks of wealth creation. From developing financial discipline to understanding the importance of continuous learning, these strategies provide a roadmap to becoming a millionaire. Every journey will have its challenges, but by applying these lessons, you're equipping yourself with the tools to overcome them and achieve financial freedom. Thank you for your time and interest. We truly appreciate your commitment to learning and improving your financial knowledge. If you found this audiobook valuable, please don't forget to like, subscribe, and share it with others who may benefit. Remember, this audiobook not only enhances your financial literacy but also helps improve your English skills. The more you listen, the better you speak. Keep engaging with our content, and together, we can achieve both financial and language success.